Thanks for joining us on Power Lunch. This is Bloomberg Quint. I'm Harsha Subramaniam.
Good afternoon. I'm Meera Dugal. Let's get straight to the headlines. Monday blues on Dalal Street. The Indian markets trading flat, slight downside bias with the Sensex and the Nifty down about 0.3%.
But there's no stopping the Bitcoin at guns for $10,000 after gaining more than 15% in a single day.
Indian exporters say they are waiting for refunds worth 50,000 crore from the government 4 months after the goods and services tax was rolled out.
But first, the markets. Weakness has crept in the beginning of the week. Neeraj is taking a closer look at some of the pulls and pressures. Neeraj.
Yeah, you would expect after so many days of gains, you would probably have a pullback. It's expiry week as well. You got to keep that in mind. Though the volatility hasn't picked up. So India VIX is pretty flat. But the markets are off at the lowest point of the day on a day when the global markets are very flat. So it's not that the European markets or the US markets or the Dow futures are showing those signs. They are fairly flat. So it's just a small pullback after the last 4 or 5 days of an uptick that we've had. Though, keep in mind, I mean, that uptick also led us to, what, 1.5% higher, not really dramatically higher. The Bank Nifty's moved lower too. It's been a disappointing week, the last one for the Bank Nifty. It's not been able to participate in today's session too, about 0.2% down. But oil marketing companies, Infosys and ITC, if you are looking at heavyweights which are putting pressure on the index today, it's got to be these. So HPBP, then look at Infosys, which is a heavyweight and had a big week, the last one on the positive side, coming off today 1.5% lower. And ITC coming off 1.5% lower as well. And there's an absence of heavyweights on the gaining side, if at all, an ONGC, which is up about 1%. Otherwise, the next highest weightage is Larsen & Toubro, which is just about 0.25%. So not enough gainers. Some heavyweights down in the session today, leading to this pressure. Volumes are okay, at par with what you would see 3 days ahead of the FNO expiry as well. So nothing great to write home on the volumes front. And while there will be odd pockets of strength, so you would have the tea stocks, you will have the paper stocks doing well. I think the real estate juggernaut has taken a bit of a pause today. So the likes of Oberoi, Kolte Patil, etc. are all off in the session today. Not across the board. I mean, Godrej Properties is okay. Marathon NextGen is on a roll really today. But by and large, the real estate stocks and the first sign of the market pull back a little bit have just come off a little bit in the session today. But as I said, there are these exceptions. Marathon Realty is up about 14% in trade. But those are few and far in between.
All right, Neeraj, thanks so much for that. That's the structure of the market, down about 0.5% on the Nifty, the Sensex down about 0.3%. But Harsha, there is another market which is in focus, which is showing no signs of weakness.
It's almost as if, I'm getting excited by this because we've been tracking this so closely. No sign of weakness at all. No sign of slowing down. We're talking about the Bitcoin. The cryptocurrency is blown past $9,000 less than a week after topping 8,000. At this rate, the Bitcoin will quickly close in on the 5-digit figure of $10,000. Is this a bubble, as many fear, or is there a future in blockchain technology and cryptocurrencies? Bloomberg Business Week explains.
Bitcoin's meteoric rise is attracting a ton of attention, but is it ready for the mainstream? JP Morgan Chase CEO Jamie Dimon recently called Bitcoin a fraud and said that cryptocurrency prices are in a bubble that will eventually burst. Many investors have stayed on the sidelines as cryptocurrencies are seen as too volatile and don't have the safeguards that most financial assets do. A number of hedge funds, however, are investing in cryptocurrencies, and Goldman Sachs is reportedly exploring how it could help clients trade digital tokens. Other companies are stepping up efforts to bring cryptocurrency to the mainstream, opening regulated exchanges, creating futures contracts, and attempting to list exchange-traded funds. The recent surge in cryptocurrency prices has coincided with a flood of interest about the blockchain technology behind Bitcoin, which uses a decentralized and public ledger of transactions that can't be manipulated. IBM, Microsoft, and Toyota have all invested in blockchain and are looking at potential applications ranging from food safety to driverless cars. So what is preventing even more widespread adoption? Regulation, or the lack thereof. In July 2017, the SEC announced that federal securities law may apply to some cryptocurrencies without providing concrete guidelines to determine which ones. Meanwhile, China has outright banned ICOs, or initial coin offerings, along with the exchanges where coins are traded. Guidelines for individuals that mine and trade cryptocurrencies also vary wildly, with countries like Venezuela going as far as putting miners in jail. So what's next in the year ahead? The cryptocurrency community is eager for clarity from regulators on ICOs, trading, mining, and taxes. As that happens, more investors and end users could dip their toes in the water. Many have compared the current state of blockchain to the early days of the internet, a digital Wild West teeming with opportunity. And just like the internet, there will likely be winners and losers.
All right, let's take this conversation forward on the Bitcoin. What's the road ahead? What are central banks saying? But before that, just take a look at the price today. Give you a sense of the phenomenal rise that Bitcoin has had. And this is just this year. That's from far left is January till this year. You've had 25% or more falls. And in the last 2 months or 2 weeks, there's been a 40% increase in the price of Bitcoin. More importantly, this is the market cap of Bitcoin has crossed the $100 billion mark. Remember, CMA is going to be starting futures trading in Bitcoin as well. But what are regulators doing and what are central banks? Why is there a certain sense of nervousness, uncertainty around regulation of the Bitcoin? Bloomberg's Chris Anstey joins us from Tokyo with some views. Chris, thank you so much indeed for joining us. What are the challenges that central banks face when regulating something like the Bitcoin? The major central banks like the Federal Reserve and the ECB, what's their position on cryptocurrencies?
Well, Harsha, we went through this exercise, a number of us around the world, contacting central banks in some of the major countries. And what we uncovered was essentially there's two groups of issues here. On the one hand, central banks and other regulators, as you were saying, need to figure out what's the approach with regard to cryptocurrencies like Bitcoin, these private sector units that have been created. What's their approach towards that? And on the other hand, they have the question of, do they go forward with creating their own digital currencies? And so there's these two sets of issues, and we came across quite a variety of opinions and statements by central banks around the world. You know, the Federal Reserve has been, very much in the early stages of looking at this, hasn't gone in with a heavy hand as yet. The chairman, the nominee for chairman for the next chair of the Federal Reserve Board, Jay Powell, was saying that, with regard to the question of whether to issue our own digital currency, well, if there are private actors already in this, maybe there's nothing for us to do. The Europeans, in terms of the European Central Bank, have been very cautious about the development of cyber currencies. One ECB official referring to it as Bitcoin as a tulip, a reference to the tulip mania of the 1600s in Holland, just as a craze. So we've seen quite a variety of views across the spectrum here.
You know, Chris, in India, of course, the Reserve Bank of India has been a bit circumspect about the Bitcoin. But are there central banks out there who actually view this favorably?
Well, certainly with regard to the idea of issuing their own currencies, their own digital currencies, there are some innovators out there. One thing that was very interesting as we went through this exercise was reading about the Scandinavian central banks and the Dutch. The Dutch have actually created their own digital currency within the central bank just for testing to see, how it works. Some of the Scandinavians, the Norwegians and the Swedes have been looking at this as a potential way of making payment systems more efficient, easier, and blockchain technology also offers transparency. So a lot of attributes that could appeal to some central banks. But at this stage, it looks like we're some years away before there's any real consensus about either of these two questions that policymakers are facing.
Chris Anstey, pleasure for joining us. Thank you so much, Anit, for joining us today. Chris Anstey joining us from Tokyo, talking about what central banks are doing. But the price there's a buyer, there's a seller, the price is going up.
Yeah, no, actually, on the point of the Reserve Bank of India, so I think there is one research paper which has discussed the idea of a central bank backed digital currency, not cryptocurrency. And we also have the Supreme Court now, which has asked the RBI and the government to clarify their stance on regulation. So hopefully, or maybe, we'll get something on that from the domestic policymakers. Moving focus to the bond markets. Bond yields are once again trading above 7% after dipping below that level last week following the RBI's decision to cancel a planned bond sale under its open market operation program. Apart from all of that, what is impacting the bond markets is the normalizing liquidity condition, with banking liquidity now close to near neutral. Karthik is joining us. He's been speaking to a whole bunch of people in the bond markets to try and understand why the mood in the bond market is a little bit somber. The feel-good factor, Karthik, as you said, more or less has died out.
Yeah, true. As you rightly pointed out, that the banking system liquidity has shrunk drastically. You would remember that when the RBI started doing its OMO sales program, the banking system liquidity was somewhere around 3 trillion rupees. It's come down to something like 30,000 crores now. So that is one of the factors that has really got the bond market participants really worried. So just to give a little bit of perspective, like Moody's ratings upgrade and the RBI cancelling of OMO bond sales were massive positives. They should have been massive positives for the bond market. But the bond market reaction has been totally opposite. There has been a kind of a bloodbath in the bond market. So the reasons are very clear, that the markets are very worried about this shrinking of liquidity, which means that, which is indicating to us that this OMO bond sales have depleted the appetite of public sector banks to buy bonds, and that is clearly that's really seen in the market reaction. So
Karthik, what are people saying about the level at which yields will settle? I think when that OMO happened, people said that this suggests a yield signal, which means that they don't expect yields to move up very significantly above 7%.
True.
But what are market participants telling you?
So it's difficult, it's no more based on the macro fundamentals that the markets can take a call on where the yields will settle down. There are more and more bearish calls now building up. For example, Emkay Global tells us that the yields could rise to as high as 7.80% in the next 6 to 12 months. DBS is calling it at 7.50 anytime in the next coming quarters. So that's, people are readjusting their expectations for the bond yields as a lot of things are weighing on the sentiment, including oversupply of bonds, fiscal concerns, faster inflation.
Thanks so much, Karthik. Lots of factors coming together, fiscal concerns, not just at the center, also at the state government, which brings us to our next topic. State government finances are adding to the concerns of the bond markets. Data released by ICRA shows that state government borrowings may remain elevated, given that revenue expenditure remains high, despite some shortfall in revenue receipts, which has persisted. Pull up that chart by ICRA, and that will give you a very clear sense of how things have shaped up between Q1 and Q2, and what is being sort of compromised at the cost of all of this revenue expenditure and slowing growth in revenue receipts is capital expenditure. That's the line at the end, which is showing that capital expenditure continues to decline. And this is data for the 12 large states which ICRA has put together. Aditi Nair is joining us on the phone line. She's senior economist with ICRA. Aditi, good morning. Thanks for taking our call. Can you just run us through what the Q2 numbers for these 12 large states are suggesting to you? The trend has actually worsened in some ways, in the sense that revenue receipts or growth in revenue receipts has slowed, but revenue expenditure remains quite high.
Thanks, Ira. You're absolutely right. We've looked at 12 states for whom the Q2 data is available from CAG, and these states make up about 60% of the total size of the budget of all the state governments put together. So it's a fairly decent representative sample that we have. And the information that we're able to glean from this data is that, as you rightly said, revenue receipt growth has slowed to around 14% in Q2 of FY18, which is the first quarter after the implementation of GST, from around 19% before that. And interestingly, the grants from the center and the non-tax revenue of the state governments, for these items, the growth has doubled between these quarters. The growth of central tax devolution has remained flat, because that's as per the design of the monthly tax devolution for the state government. Where things have really slowed down is the growth of states' own tax revenues. Our estimate based on the data that's available is that growth of the state-owned tax revenues came down to 8% in Q2 from about 22% in Q1, which was quite healthy. So the 8% growth definitely is something that we need to watch out for. We have to keep in mind that about 40% of SOTR, which is the state-owned tax revenue, has been subsumed into GST. Possibly one of the major reasons for why this growth has come down in Q2 has been because of the IGST collections, which would eventually flow to the states. So we think that there is a element of a timing mismatch both in terms of the IGST as well as the GST compensation stress. And possibly these are the two major reasons for why this revenue receipt slowdown has happened in Q2.
Aditi, just one question from me as well. This is Harsha here. The sharp fall in state tax revenues that you point out from 22% to 8%, and you're saying this has largely been caused by the dislocation created by GST. Do we have any sense of things improving on the ground? Because, you know, the on-ground situation is much worse than what the numbers are showing. So if this be the case, then it only indicates a further, hit on capital spending, doesn't it? I mean, revenue lesser than what is going out.
Thanks, Harsha. Definitely on the expenditure side, revenue expenditure growth, if anything, it went up in Q2 despite the revenue situation. And that's really pointing to the stickiness of such expenditure. And the contraction in capital outlay worsened to 24% in Q2 from 14% in Q1. Now, partly this is because of reprioritization of expenditure, because of crop loan waivers, Uday debt servicing, etc. And a little bit is also because of the base effect related to the actual takeover of Uday debt in the previous year. So we do need to keep that in mind. But overall, the trend up till Q2 was definitely quite discouraging in terms of capital outlay. And obviously that has implications for overall investment activity in the country. Now, coming to your other question of do we see any sign of improvement, we do in a slightly oblique manner. And the oblique manner that I'm talking about is the debt that the state governments raise from the bond markets, which is called the state development loans. Here we've seen a massive 40% increase in the state development loans in Q2. And we've actually seen a contraction in October and possibly in November as well after the auction happens tomorrow. So my best guess is that the Q2 data did look so bad because of the timing mismatches caused by GST, but things seem to have eased out considerably in October and November, going by what we are seeing in terms of the state development loans.
Aditi, what is your estimate of how much states will raise this year? I remember that recently you had raised the estimate of the amount that states will borrow. What was that estimate and does it still stand?
So we had actually raised our forecast for full year SDL to 4.8 to 5 trillion for FY18. This is on a gross basis, looking at the 40% growth that happened in Q2 in SDL for all 29 states. Now, I would say that after the contraction that we've seen in October, November, we're not entirely surprised by that, but certainly the contraction has persisted for quite a long time, 2 entire months out of the 6 months which were remaining in H2. A couple of points that I'll still, point out in terms of what are the stress factors which are still there for the government borrowings. One, of course, there is still a large amount of redemption of SDLs which is yet to be done in FY18. So that's something that would put upward pressure on the borrowings from December to March. And secondly, there still hasn't been too much of actual outflow on account of crop loan waivers by the states that have announced it. Now, we don't know whether that will actually happen in FY18 or how much of it will happen in FY18. So this definitely is a sort of known source of uncertainty as to how large the bond raising in the rest of the fiscal year would be. I would still say that possibly between 4.5 to 4.8 trillion seems to be a reasonable estimate for the full year SDL in FY18.
All right, Aditi. Thanks so much for that. That's state finances for you.
Aditi Nair from ICRA joining us with those details. Meanwhile, bond sales by Indian companies to individuals have taken hit a 5-year low. India Inc. prefers to tap cash-rich banks. Divya Patil of Bloomberg News joins us with an analysis. Divya, what's going on? So we are saying that the public bond sale is down to a 5-year low. What's been the reasons behind that?
That's right. Public sale on a year-on-year basis are down about 84%. And the main reasons are that, private placement of bonds and bank lending is much cheaper for companies to go and raise funds rather than come and do a public issuance. The other reason is that, equity markets have been doing very well. And it's very evident, we've seen record IPOs, we've seen a lot of rights issues this year. So it's very evident that, companies are trying to max out their benefits by tapping the equity market rather than selling debt. So these are the main reasons.
So I also hear that if the process was simpler, many people would bite. What are companies saying? What are investors saying?
That's right. So companies want the process to be shortened because this is a very long, tedious process. You have to go through a lot of approvals. You need more disclosures. Plus, it's expensive because you also have advertisement cost attached to it. So yeah, companies want regulators to help reduce the process, and they also want exchanges to streamline the way individuals can come and invest in bond markets. They say that it should be very simple and easy, just like your equity markets.
All right, Divya, thanks so much for that. That's public sales of bonds. Moving on, but staying with the macro economy, India's exporters are a worried lot. 4 months after India's GST was implemented, traders are still reportedly waiting for as much as 50,000 crore in refunds. To discuss the situation in detail, we are joined on the show by A. Saktivel, Regional Chairman of the Federation of Indian Export Organizations. He's joining us on the phone from Chennai. Good afternoon, sir. Thanks so much for taking our call. What is the situation on the ground, sir, in terms of refunds? What are exporters who you interact with telling you?
See, actually, that refund is not taking place. The government announced we can apply manual also. Manual also, they said 6A form could be used for a refund mechanism, but that is not accepting in the system. So we have talked to custom official, and also we are taken up with the member customs in Delhi. So they are through PO, they are working on it. Hope within 2 or 3 days we get some clarification how to get the refund. Otherwise, the situation is bad because all our money got stuck with GST.
How bad is your working flow, working capital issue at this point in time, Mr. Shaktivel? And can you explain to us what those operational challenges are?
Are really suffering because now the drawback rate also reduced from borrow sell and drawback reduced from 2 to 3%, 11.5% to 3%. So there we are losing 8%, plus whatever GST we paid from July onwards. So that GST also got stuck now. So the refund mechanism also not working. So the working capital is really got hit now.
So what are you asking the government? I mean, are you asking for a near-term mitigate?
That by the time you system all get ready, you restore the same drawback as we are getting it earlier. Up to September they allowed. I said we are requesting up to March 2018 you restore the drawback same way and also RSL also, so that the GST can be taken from April 1st onwards. So whatever GST we will not claim whatever the GST we paid in drawback route. So we are saying that let the drawback route continues.
Okay. Just one question, sir. While we have you with us, outside of this tax issue, we've been talking about an export slowdown for a while. Specifically in the textile sector, what is really going on, particularly for the small and medium-sized guys? Is it a situation where you're letting go of people? Is the situation so bad on the ground?
Yes, because we are not able to book orders now. As I said, that from 11.2% we are getting 3%, 8% is been taken away, and we all work in a very thin margin of 2 to 3%. So by taking order even with the world rate, we'll be losing money. So unless otherwise the government comes something to help us out, we'll be in a bad position.
Proposals, sir, that you're taking to the government which can provide relatively sort of immediate relief?
Immediate relief, see, up to September they allowed the drawback to continue. We are requesting up to March 18, the drawback system should continue.
Okay. Essentially, you want the duty drawback scheme to persist. Thank you, sir. Appreciate you taking the time to explain this problem to us. Certainly not positive, given that we've seen pressure on exports for the last couple of months. If this continues, as Mr. Shaktivel was explaining, could continue to see that pressure persist. Slip into a short break. Come back on the other side. Adani Enterprises may take a hit after the Labour Party looks all set to retain power in Queensland. We'll explain the dynamics then to you.
Are we live?
Welcome to programming that's insightful, authoritative, and at your fingertips.
Bringing news alive. So immersive, so new, and so addictive. You will want it no other way.
The Bloomberg Terminal, accessed only by over 325,000 marquee investors across the world until now.
Just business news, we're news for business people.
Welcome back. You're watching Power Lunch. Let's get straight to the headlines at the half hour. Monday blues on Dalal Street as markets slip into consolidation mode, with the Sensex halting its 2-month winning streak.
Adani Enterprises is on the back foot after the Labour Party looks all set to retain power in Queensland.
And Morgan Stanley expects the global economy to grow at 3.8% in 2018, despite a partial rollback in stimulus in the US and China.
Well, it's been a weak day for the markets at this point. Navneet is taking a closer look at some of those movers and shakers. Navneet.
Well, Asha, it's been a weak start to this expiry week. It's an all-important week. The November series expire. But if you look at the indices right now, I think we're off days low. Nifty is back to levels of 10,355 at the moment. Bank Nifty, which opened weak, has seen a bit of recovery. The Nifty PSU Bank specifically is off days low. And in terms of broader markets, actually, they are the ones which are outperforming the benchmark indices. So if you look at the Nifty mid-cap index or even the small-cap index, they've managed to trade the day throughout the day, in fact, in the green. And because of that, you've also got the advanced decline ratio so far, which has been in favor of the advances. The NSE stats there on your screen, almost 8:6 right now in terms of advanced decline. In terms of sectoral gainers, you've got the likes of Nifty Realty and Media indices. Both these index have been trading in the green. You've got stocks like TV18 Broadcast, which was up on Friday, has seen a stellar day once again today. Alongside, you've also got Dish TV from the media pack, which is doing well. From the real estate pack, India Bulls Real Estate is the one which is gaining in today's trade. And besides that, DLF, which came out of the F&O ban, is trading up and about. India Bulls up almost 5% and DLF is trading with gains of 2%. Well, it is the heavyweights like Infosys, Tata Motors and ITC among the Nifty constituents which are actually dragging the index lower today. And in terms of themes, what's working out, the paper stocks have seen a good jump up coming about from the likes of West Coast, Seychelles, even Tamil Nadu newsprint trend. All these stocks have seen a good gain so far. West Coast is up almost 7% and Seychelles paper up about 8%. Couple of other gainers, just quickly I want to highlight. Himami has touched its fresh 52-week high, so that's trading with gains of almost 4% right now. Motherson Sumi brokerage is pretty bullish on Vision 2020, so that counter is up almost 2%, and Mindtree and PC Jewelers continue to gain in today's session.
All right, Navneet, thanks so much for that. That's the structure of the equity markets here at lunch. But we'll move focus and shift to the commodity space. Crude continues to hover around a 2-year high. WTI is trading just below the $59 a barrel mark as a crucial Canadian pipeline remains closed. Meanwhile, we are watching ahead to see what comes out of the OPEC meet later this week. Joining us in the studio to talk about oil, but also the broader commodity space, is Peter McGuire, CEO at XM.com Australia. Peter, lovely to have you here in Mumbai. Welcome.
Thank you very much, and lovely to be here.
Let's start with oil, Peter. For us, it's all important to see oil not take out that 60 mark and then, trend above that.
Sure.
What is your sense of where we're going on oil, just based on the dynamics right now? And we'll talk about oil in a minute.
Well, I think, that US dollar has come off a little bit over the last couple of weeks, and that's down now at that 92, 93 sort of level as far as the US dollar index. I think there could be further softening. What happens there as far as Janet Yellen, do we see a rate rise in December? And then rolling that across to crude, the momentum's certainly one-way traffic, and it's been stacking long positions really for the last month and a half, 2 months, the hedge funds, and they've pushed it, and certainly the market is very much appreciating it. So I think there's got the potential. WTI could take that $60 level out. I wouldn't be surprised. I'll be attending the meeting on Thursday and going to Vienna. I fly out tomorrow night to Vienna, and I think it'll be a fascinating couple of days.
I was looking at some of the Bloomberg data, and one report said oil has been up nearly 24% since September, on the back of expectations or speculation that OPEC is going to be extending that production cuts.
Yes.
What's the thinking that OPEC has right now, and particularly the non-members of OPEC who seem to be wielding a lot of influence?
Well, exactly right. The Russias and so on. It seems to be very much a collective. I think there is a number of issues at play. First off, they certainly want to see a higher crude price. They've been hemorrhaged as far as balance sheets. Saudis, have a look at it. All of these particular Middle Eastern nations and the likes of Venezuela. So they haven't done well out of cheap oil. There's the other thing in the background that people need to be conscious of, and that's the largest IPO in history. Comes Saudi Aramco, which will be floated, or a percentage of be sold to market sometime in 2018. And from a valuation perspective, you want to see a higher crude price, not a lower crude price. The extension of cuts, I think they'll roll them out probably an extra 3 to 6 months. That's what I'm tipping, and I think that'll probably happen till June 30 next year. There'll be another meeting late May, and I think that's how it'll play.
Purely on the demand dynamics, Peter, I mean, we were hearing some global brokerages saying that they expect growth to remain strong into next year. Earlier, the anticipation was that after a strong year, you'll see growth petering out. But if that remains the case, that growth remains strong and some of these supply restrictions stay in place, could that on its own sort of merit take up oil?
I think it could, but I think there's also the other side of it, which would be a handbrake US production. Quite simply, the shale revolution, the shale guys, they must be very happy. They've been able to, through technology and innovation, be able to crimp their, as far as costings, down to about $40 a barrel. So if they're going to sell this stuff at 60, there's plenty of profit there versus what they were experiencing a few months back. Do we see an increase as far as shale producers and more rigs come to line, and what impact that's going to have as far as export, as far as US crude? So I think over the next year or two, it's going to be a fascinating market. Traders are very happy with it, and undoubtedly, wonderful volatility, which in turn is great for any trader.
I'm glad you said that, because last week there was a very interesting quote from the UAE energy minister who said shale is not an enemy of the OPEC.
No.
So do you see the supply glut to continue then for the next 6-8 months, and therefore prices to remain at these levels?
I think it will continue. There's no doubting that. And to get back to 5-year averages, it's just that the world is awash with oil. Through the shale side of it, but everyone is producing and able to, through technology, retrieve oil at a cheaper price and go deeper into the Earth's crust, be it deep ocean or go into places where you had retrieved oil and they were nearly dry. So you've been able to, through fracking and other services, being able to tap into increased supply or increased production. And how that plays forward, I think that we're going through a changing of the guard. No doubt we're at that 4th industrial revolution, but what's the other side of it? Electric vehicles. what moves forward as far as new age energies are going to possibly make crude oil redundant in that 10 years. That's where the world's thinking, and that's going to be fascinating when you like, you know, battery vehicles, all of those contexts come into play.
All right, that's the long view. Want to switch focus a little bit towards the metal side as well. What's interesting in the metal complex? We've seen a run up this year. We've seen some metals coming off in the last few days, though.
Yeah.
What's the call on the metal space?
I think it was exhausted to the upside. Yeah. Like any trade, you know, it runs out of steam. Copper's been fantastic, so is nickel. There's huge production, and certainly the consumption side isn't going away. Pots, pans, you name it, we need more of it. More people entering the market. The old Jim Rogers state, more cooking utensils. I just don't see, and really, when you look at it, it's very cheap buying today. Considering where zinc was, we had $52,000 a metric tonne, collapsed to $9,000. Now it's only about $12,000 or $13,000. Copper's very, very affordable compared to where it has been. So all of these markets, I think, are on an upward trend. And I don't necessarily think the commodity cycle really was broken. It's just an extension. They go for 25, 30 years. This cycle's going to be a little bit different. It's got longer time horizon.
We can't let you go without asking about gold.
Yep, $12.92 an ounce. I reckon it's cheap. Because what happens to the US dollar, what happens to geopolitics, it's been a great trade, and I think it'll probably oscillate around this sort of number.
Peter Maguire, many thanks indeed for joining us with your perspective. Interesting. Thank you for stopping by.
Thank you.
All right, that's commodities for you, but let's shift focus back home. The IBC ordinance that's intended to rule out defaulting promoters, but it may actually end up hurting independent bidders as well, it seems, if the lawyers' interpretations are right. Menaka is here to explain to us why the drafting of the ordinance has thrown up a lot of confusion.
Well, there is some concern about poor drafting, specifically if you've read the ordinance as many times as some of us have, then it has to do with the definition of connected persons, which in turn has to do with the definition of related parties. And let me give you a couple of illustrations of why this is raising a few eyebrows. Now, this is not to suggest that the two companies I'm going to talk about are necessarily going to be ruled out of bidding for insolvent assets, but the interpretations are sort of causing a cloud of confusion around these two. For instance, first up, let me say ArcelorMittal, which is a more than 20% shareholder in Uttam Galva, which is a distressed company. Now, the related party definition includes someone who is more than a 20% shareholder, as a result of which ArcelorMittal is considered to be a connected person to Uttam Galva. Some might interpret, as a result of which ArcelorMittal may, some might say, not be able to bid for any of the insolvent assets. Now, there's another interpretation to it, suggesting that actually all this does is to restrict ArcelorMittal from being able to bid in an Uttam Galva bidding process, if that were ever to come to fruition. Others say no, it might be a slightly more overarching restriction than that. We don't know the full, the full outcome of this as yet, and that's because the drafting is confusing. The second illustration is to do with JSW Steel, as you know, is promoted by Sajjan Jindal, who is the brother of Naveen Jindal, whose JSPL was very recently labelled an NPA, and that was just for a very brief period of time, so to speak. Could that have jeopardized JSW Steel's ability to bid for the many assets that it's interested in? Now, no, because JSPL has not been an NPA for a year or more, which is what one of the criterion says in the ordinance. But again, this is just to underscore that even if JSPL had been an NPA, surely that should not have restricted JSW Steel from being able to go ahead and participate in the insolvency process of a couple of assets. They've expressed interest, I think, in one steel asset. They've expressed interest in the JP Infratech asset. So I think these are just two illustrations to show you how the language can be confusing, and hence why lawyers are a little concerned and were hopeful that there would be more clarity. I asked JSW Steel about this. They were categorical about the fact that no, their company does not attract any of the ineligibility criteria in that ordinance. But they did say that yes, the way the ordinance is drafted, this does put now a new burden of paperwork on them. For instance, JSW Steel has more than 35 promoters, right? So now, every time they participate in an insolvency process, they have to explain to the resolution professional how none of those 35 and more promoters are in any ways connected to any NPA situation in the past, right? So that's just a bigger burden of proof to have to present to the resolution professional, and you have to do that every time you participate in this. And that's exactly the quote we have from Seshagri Rao, where he says, now I have to sit with every resolution professional and explain with detailed documentation that I don't attract these ineligibility criteria. So this is some of the pain emanating from the drafting. There are more scenarios in which lawyers have raised questions. For instance, is it possible that a foreign bidder may be connected to an NPA elsewhere in the world and now therefore becomes ineligible under this ordinance because of the way one criterion has been worded? I won't get into the technicalities, but that's one interpretation. The second one is the criterion says that if a director has faced disqualification, then the company connected to that director cannot participate in the bidding. Now, we've just seen 3 lakh directors be disqualified because of the government's crackdown on shell companies or non-conforming companies. And so, there is a little bit of concern on that front as well. These are only illustrations to tell you how the drafting is creating confusion.
Quick question, Menka. What is the route to clarify these doubts? Is it only when something gets tested at the IBC, at the resolution professional, and then perhaps in court? Or can some of this be corrected between now and Parliament, when Parliament?
Yeah, it is. So every ordinance has to be affirmed by Parliament within the first 30 days of Parliament sitting. We know the winter session will sit on the 15th of December, at which time this ordinance will, in the process of a law or in the shape of a law, have to be passed through Parliament. At that time, they have the opportunity to clean up some of the language and make it clearer. That's the first opportunity. Ultimately, all laws are tested in court, as you know. So if there is any continuing ambiguity, that has to be tested in court, but that will only add to timeline delays. And you know that the whole success of this IBC is predicated on quick timelines. So it's critical to be able to get rid of as much of the confusion as you can up front.
All right, Menka, thanks so much for that. That's the IBC story, which is going to continue to be in focus. Meantime, we'll shift focus to Adani Enterprises. Their hope of getting a loan from the Australian government is fading, with the incumbent Labour Party in Queensland set to win the polls. The Carmichael coal mine and the port linked to the project has faced a lot of resistance in Australia, with locals in the area opposing the project right from the start. Nikki Mirchandani joining us with what has happened and whether this could mean another potential setback for the Adanis. Nikki.
Sure, Ira. It's been more than 7 years of battle for Adani in terms of the Carmichael project. If you see, Labour has set to win the Queensland vote, which is going to be a blow not only to the government but also to the company. The parties have disagreed to back federal funding for a new rail link to carry coal to the coast. The Labour government has voted to reject the $900 million funding should it be returned, which is a major blow for Adani. What the company stands to lose with this development, if you see, the company has already invested around $3.3 billion in this project, and this investment includes buying the bulk coal handling port of about Point. If you see in the chronological order that the events have taken place right from the year 2010, when the Adani bought Greenfield Carmichael coal project, then in 2011 when they signed a pact with the port of Abbott with Adani. In 2014 we saw the Commonwealth Environment Minister giving the required approval. In 2015 then there was some rejection coming in from the owners. SBI in the month of December 2015 too rejected a loan to Adani Group. Australian court too rejected, but then on the good side we saw the Australian court rejecting the environmental group plea to stop the project. 2016 again a set of issues that were plaguing the company. In December 2016 though, we saw all the major states and federal government approving the secured project. 2017 we saw the owners actually again going back to Adani and urging to abandon the mine project, threatening them with legal notices. In April we saw water license coming through. May we saw the royalty agreement coming through, and June we finally saw the final investment approval from the mine and rail project. But then the company still stands to lose $3.3 billion if this investment doesn't, the approvals, if the Labour Party continues to win by a majority. What are the objects of these projects? So typically the mine will open up the basin, which is going to be the bigger asset after UK. It's going to source coal to India, and also it will generate around 10,000 direct as well as indirect jobs in Australia for that matter.
Nikki, thank you for that. That's the story on Adani. But let's move on now. Motherson Sumi has gained over 3% today after the company reported strong September quarter numbers. In the analyst meet, the company highlighted its plans to look beyond auto. Yatin is here with some details on the road ahead and what brokerages are saying. Yatin.
Afternoon, Harsha. And if you look at Motherson Sumi, they met a couple of analysts, and in the analyst meet they pointed out that they will be maintaining the Vision 2020 of the company, which is basically delivering a strong top line growth with a 40% return on capital employed. So they have reiterated the 2020 roadmap. Of course, the analyst had questions on the electric vehicle revolution and how really will it impact the company. But the company was quite confident that in the short to medium term, the opportunity is quite large for the company, and electric vehicles do not pose a threat as far as their company is concerned. In fact, they say that top 6 to 7 electric vehicle models, the vendors have been from the Motherson Sumi stable, which is basically either Motherson Sumi supplying them goods or the subsidiaries working on the electric vehicles. Of course, they also said that BS6, when implemented moving forward in India, that will increase the wire harnessing business by 30 to 50%, and that was one of the key positive takeaways. Apart from that, the company said that moving forward, inorganic growth opportunities is also something that will be driving the growth for the company. And also they said that as a part of the group strategy beyond 2020, Motherson Sumi will be reducing its dependency on the auto industry and will be venturing into various non-automotive business. So these are the few key takeaways for Motherson Sumi. Of course, if you look at the brokerages, most of them have not changed the rating, neither they have changed the target price, with most of them having a neutral rating on the stock.
Yathan, thank you for that. We also spoke to the management of Motherson Sumi, Chairman Vivek Chand Sehgal, on the impact of the shift to the electric vehicles on auto component makers like Motherson. Let's listen to what he had to say.
It's not a disruption. It's just another option to drive the car. I mean, there is no whatever the hype that people are creating. We are okay with that. As Motherson, we are agnostic to it. But I feel that it is a bit overdone. There's a lot of possibilities. It's a very exciting. There are certain challenges. Those particular challenges have to be overcome, and depends upon how fast the world will react to these requirements. And if they react very fast, all the governments react very well, well, it's going to happen maybe in 10, 15, 20 years. It also opens up tremendous amount of opportunities for existing technologies to also disrupt this electric vehicles.
Vivek Sehgal from Motherson Sumi. All right, Titan is now among the top 3 listed Tata Group companies in terms of market cap. PR Sanjay from Bloomberg News is here to tell us how the pecking order of the Tata Group has changed thanks to Tanishq and Titan's spectacular performance.
Thank you. It's time now for Titan, and thanks to the shift, the intentional shift done by the management team, from a watchmaker to a jewelry maker. So now around 79.8 to 4% is coming from jewelry business. So that itself made a lot of sense. And of course, demand is also picking up. And one should not forget about GST. After a lot of rollbacks, rollbacks are also helping Titan in big way to position Titan as a third most valuable company in the Tata conglomerate.
So this comes after TCS and Tata Motors in the group. Talk us through what they've achieved this year that's led to the spectacular rally that we've seen in the stock.
In simple terms, if you've seen the last year profit, annual profit, they have already achieved that much in first 6 months. That itself is a big boost. And if you've seen, immediately after announcing the results, it has shot up by 19%. From the rally continues, because after that, it was followed by the series of rollbacks by government after hearing a lot of issues. And if you could see, and even now the GJEPC also asking for a lot more incentives, which could be considered by the government. So a lot of positive factors which is helping Titan to sustain this kind of rally.
Great rally for the stock. It's become the third most valuable company in the group. Sanjay, thank you so much indeed for joining us with those details.
All right. It's been more than 9 years since Lehman Brothers filed for bankruptcy, taking the wind out of the sales of all equity markets across the world. It was, in fact, the largest global sell-off since the 1990s. All of that is well known. I think what we're trying to do right now is see how markets have performed and how individuals perform, stocks have performed since then. Darshan Mehta is standing by with that analysis. Darshan.
Yeah, so what we've done is that we've decided that if post the Lehman crisis, so we've taken 1st of Jan as a date of 2009 because of calculation. So if you had in the market cap of the Nifty was was 19 lakh crore, and now the Nifty is worth almost 75 lakh crore. So if you had invested in the Nifty, you would have gotten almost 3.5 times the return that you had. A lot of companies did manage to outperform the Nifty. The Nifty was up almost 340%. So these are the companies from Ranbaxy right up to Maruti. Maruti is up almost 15 times. HCL Tech is up almost 13 times. Tata Motors up to almost 11 times. So a lot of companies did well, and some of the companies that didn't do well, you've lost most of your wealth. Reliance Communication down 94, Unitech, you've lost 86% of your wealth. Suzlon, Reliance Power, you've lost substantial wealth in these companies. Now, as far as the entire, if you analyze the data that's there, 24 stocks have outperformed the benchmark indices, given returns of more than 240%, and 10 stocks gave negative returns because of on the Nifty. Now, there were also some bit of corporate announcements that happened. Sterlite merged into Sesa Goa, and then Kane was merged, and the entire thing became Vedanta. You had Ranbaxy, which got acquired by Sun Pharma. You had Reliance Petroleum, which got merged into Reliance Industries. And the scam hit Satyam Computers was acquired by Tech Mahindra. So these are the corporate actions that did happen, and significant amount of returns that was seen on the Nifty as of now.
If someone had invested a lakh of rupees way back in 2009, what kind of value are we talking about?
Yeah, let's keep it simple. 50,000, 50 stocks. So 50,000 in the Nifty in 1st of Jan 2009, and 1,000 rupees each in all the 50 constituents, not as per market cap or weightage. 1,000 rupees in each of the 50 stocks. Now, if this was the scenario, you would have outperformed in the 50 stocks, despite some of them, 10 of them giving negative returns. So if we pull up the plate in which we'll show you the calculation, Nifty 50, if we had put 50,000 rupees each, you would have made 1,21,000 from 1st Jan 2009. And if you had put 1,000 rupees in each of the 50 stocks, you would have made 1,50,000. That's an excess return of 24%. Nevertheless, if some of the counters were down. Some of the marked outperformers include Maruti. 1,000 rupee in Maruti would have gotten you 15,500 rupees. That's a return of 15 times. In counters like HCL Tech, it's up almost 1,000 rupees, would have gotten you almost 14,000 rupees. Counters like Tata Motors, you had your TCS, as well as M&M. So all these counters gave you substantial, more than 10 times returns that came in. The wealth destroyers, Reliance Communication, if you had invested 1,000 rupees, you would be left with only 60 rupees. 94% of the wealth has been eroded. Similar with counters like Unitech, 1,000 rupees, you would be just left with 140 rupees. Counters like Suzlon, 1,000 rupees would be just 210, 86, 70, 80% wealth reduction. Similar case with R Power, and a lot of companies belong to the ADAG group. There is no doubt about it. And BHEL, 50% of your wealth eroded. So significant amount of wealth has been eroded. But just to give you a perspective, if you had invested significant amount of money in multi-baggers, like if you put 10 lakhs in Maruti in 2009, you could afford this Audi RS7, which is worth 1.6 crore. Similar is the case with an HCL Tech. You could buy a BMW M series, which is worth 1.4 crores. Similar again in Tata Motors, you could buy this 1.3 crore car. Similar with TCS, you could buy this Jaguar, which is worth 1.1 crore. And finally, you could buy a Porsche if you had invested 10 lakhs in M&M in 2009. So clearly, stick with the winners is the theme that this data is indicating, and don't marry a stock, lose the ones that are underperforming.
All right, it doesn't hurt at all. If you had invested about a lakh or 10 lakh rupees in M&M and driving a Porsche today, that's the story of the markets. Darshan, thank you so much indeed for putting this in an illustrative fashion. All right, Morgan Stanley expects the global economy to move to about 3.8% in the next 3 or 6 months. Chetan Ahia, Chief Asia Economist and co-head of global economics at the investment giant, told Bloomberg that the pickup will happen irrespective of a rollback in some of the fiscal stimulus provided in the world's two largest economies, US and China.
In terms of the risks, the risks are essentially in the two of the largest economies, right? So it's the US, where we're watching the corporate credit risk and therefore the implications of that on overall growth. And then in case of China, they are taking up tightening, but it's never easy to deleverage. And so we're watching that the pace at which they tighten shouldn't be big enough that it causes a meaningful slowdown. But at this point of time, our base case is that global growth will hold up stronger for longer.
You could argue that, some of the drivers are kind of fading, right? I mean, the smartphone boom is done and dusted. Where do you see as the next leg then for growth next year?
Well, essentially, I think in terms of the composition of GDP, what we are forecasting is that the capex growth will pick up in both EM and DM, and we already have the evidence of that happening in DM. In EM, it should happen in 2018. What is happening is what we are seeing from EM's perspective is better trade dynamics is helping the overall equipment and machinery capex in EM. So if you look at the trend in Asia, for example, at the margin, with this now sustained pickup in growth in exports, we have seen even the machinery and equipment capex picking up. So it's actually the improvement in the capex cycle. That's what is sustaining growth stronger for longer.
But Chetan, tell us where you are in terms of your inflation forecast, particularly here in the U.S.
So in U.S., I think the focus is on core PCE. So we expect it to remain somewhat soft until February 2018 and then begin to pick up. So it goes to 1.7% by August 2018 from around 1.3 that it is right now. Okay. And that gradual pickup will, we think, give the confidence about the U.S. core inflation picking up too.
Okay, but why? Why do you see this pickup come second quarter in 2018?
So as you know that unemployment has been dipping below the Nairu levels, and we see that continuing to push then wages higher. At the same time, we are seeing that the trailing dollar weakness is going to support, which tends to be a big important driver for core goods component. And then finally, we are seeing China's PPI now sustaining in the positive territory. So from global or the EM price pressures, which were there for a long time in 2015 and 16, those are also abating. So all the three factors, better wages and dollar as well as global commodity prices and China PPI will push the U.S. inflation towards that 1.7%.
All right, that's Chetan Nair on the global economy. We are, before we close the show, going to a Bloomberg Quint news break. The China Development Bank has filed for insolvency proceedings against Reliance Communication. That's breaking news coming in. Vishwanath Nair standing by with the details. Vishwanath, what do we have?
Right, so it's all at this point in time, sources are confirming to us that China Development Bank, which is one of the few international lenders that Reliance Communications has filed an insolvency proceeding as of Friday. This is at the Mumbai NCLT, is what our sources are telling us. As part of its filing, CDB has also said that Alvarez and Marcel will be the resolution professional preferred by them. This, of course, has to be approved by the NCLT, and all of this case proceeding will be pending. And Reliance Communications, as such, already has some insolvency petitions pending against it. One by there's Manipal Tech. There's also Ericsson India who have filed insolvency petitions against the company in the past. So that is still pending. We are waiting to see what the NCLT decides on those matters. And now with CDB entering the fray, it sort of puts the whole matter into bigger discussion now.
Let's put this in perspective. The two insolvency proceedings we're talking about are operational creditors.
Operational creditors.
This is the first financial creditor to have filed.
Yes, that is true. So this is the first time the financial creditors filed. The domestic lenders have all held back from any action because they say that there is an SDR proceeding and therefore the company has about an 18-month standstill period. So they're not going to act on any of this. Now, an international creditor has come up front and filed for an insolvency petition, which essentially means that all of the financial creditors in India as well will be pulled into the matter, and then they will all have to work on a resolution plan if the NCLT admits the case.
Various unanswered questions. The biggest one in all of this will be whether this has a bearing, or if one of these petitions get admitted, whether it has a bearing on the SDR which banks invoked, because Indian lenders have still not classified this as a bad loan.
But if we go by the insolvency petitions, the insolvency and bankruptcy codes dictate that says that it overrides all of other, unless it is in opposition. So if that's the case, then SDR will get thrown out of the window, and then the insolvency proceeding will just start, and then resolution will go accordingly under that. So whatever they planned under SDR can, of course, be part of the insolvency petition, but this is still a longer discussion. We'll wait till the admission actually happens.
All right. The big news there that Vishwanath Nair was bringing you is that RCOM is facing now an insolvency petition from the China Development Bank.
All right, out of time on the show. Thank you so much for watching. We'll continue talking about the story and much more on Countdown that's coming up next. Take a look on how the markets are at this point. Also take a look at how the RCOM stock has reacted on that breaking news. Thanks for watching.